The multi-year legal war between the Securities and Exchange Commission and the digital asset infrastructure layer is officially over. The final fine is paid, the appeals are permanently dead, and spot exchange traded funds have pulled in over $1.4 billion in fresh capital. Yet your portfolio remains trapped in a grinding, multi month consolidation phase. The high contrast headlines promised an immediate, explosive breakout the moment the regulatory shadow lifted. But instead, you are staring at a flatline chart that refuses to move. You feel frustrated, exhausted, and deeply disappointed. This happens because you are applying a legacy retail bull market trading model to a highly restricted institutional ledger system that operates on an entirely different timeline. You watch the news, but the price stayed flat. That distinction matters because you are watching public media narratives while the underlying market mechanics are watching systemic liquidity locks. Wall Street did not clear the legal framework to pump your retail spot positions. They cleared it so they could slowly and methodically re engineer the cross border settlement plumbing without triggering a sudden collateral destabilization event across sovereign balance sheets. If you are a macro investor or an institutional asset manager trying to understand why absolute legal clarity has not translated into an immediate retail supply squeeze, you must stop looking at retail chart indicators. You have to start auditing the internal operational rules of the new financial architecture. The asset is not broken and the system is working exactly as intended, but the timeline is being dictated by private central banking risk models that do not care about retail expectations. The core mistake causing mass retail capitulation right now is the belief that court orders create organic price discovery. When the secondary market transactions were definitively ruled as non-securities, retail investors expected a wall of speculative buying to drive the asset back toward historic highs within days. What actually occurred was a structural decoupling. Legally clarifying an asset class does not automatically inject instant transaction velocity into a public ledger. It simply allows the institutional compliance layers to begin their standard 18-month due diligence protocols. The commercial banks, regional clearinghouses, and global payment processors that require counterparty-free collateral are legally prohibited from buying digital assets based on market hype. They require finalized internal risk ratings. They require approved custody arrangements under the new broker-dealer framework. They require clear asset-backed settlement guidelines. While the retail community sits in a state of deep disappointment over the current price tape, major banking networks are quietly transitioning out of isolated testing sandboxes and into live ledger integrations. The float is not being squeezed on public retail exchanges because the volume required to move a multi-billion dollar sovereign settlement infrastructure does not route through public order books. You are expecting a standard retail crypto hype cycle for an asset that has been explicitly recategorized as a foundational educational macro asset. The consolidation phase you are enduring is not a sign of fundamental weakness. It is the mandatory operational delay required for the largest balance sheets on earth to build their private receivers. To see what the broader market is hiding, you have to audit the massive divergence between retail sentiment and institutional capital inflows. Since the launch of the spot digital asset exchange traded funds, over $1.4 billion has quietly moved into the institutional custody layer. On any traditional financial asset, that level of sustained accumulation would have driven a massive, multi-week upward trend. Yet the public spot price remains completely pinned within a tight structural macro range. This occurs because institutional exchange traded fund inflows do not hit the public spot market in a way that triggers retail price momentum. They are handled via over-the-counter liquidity desks and private institutional matching engines designed specifically to suppress volatile price spikes during accumulation phases. The market-making entities are systematically absorbing the available liquid supply without letting the public order books register the demand velocity. This keeps the asset looking completely dead to the casual retail day trader who relies on basic moving averages. The institutions are intentionally exploiting retail disappointment to clean out the public float at a steep discount. They want the impatient retail holders to capitulate and sell their tokens back into the private liquidity pools before the live network utility activations go online. You are being systematically shaken out of an elite macro position because you are measuring an institutional infrastructure rollout with a broken retail stopwatch. A massive wave of retail misinformation has emerged during this consolidation phase, claiming that the deployment of the new private stablecoin infrastructure has rendered the native liquidity token obsolete. The narrative suggests that because commercial banks prefer the absolute peg stability of a dollar backed token, the native digital asset will never experience true transactional demand. This is a complete inversion of how the ledger plumbing operates. A stablecoin is a representation of legacy fiat debt, meaning it still carries traditional counterparty risk and requires centralized reserve matching. It cannot act as an independent, counterparty free systemic settlement bridge across international borders. The stablecoin infrastructure was not built to replace the native utility token, it was engineered to amplify it. The stablecoin acts as the operational payment face for corporate enterprises that require fixed pricing models, while the native digital asset operates silently in the background as the high velocity liquidity vacuum that absorbs and settles the underlying value across different fiat pairs. The institutions are routing the front end data through stable tokens while utilizing the native ledger asset as the actual mechanical clearing mechanism. The retail market cannot see this because they do not understand the structural difference between an accounting unit and a settlement asset. Chapter 2: The Core Banking Matrix and Private Risk Models, Scene 5. The second phase of this macro audit requires us to look directly inside the internal risk management architecture of Tier 1 commercial banks. Retail market participants believe that a commercial bank can simply open a corporate account on a centralized digital asset exchange and begin purchasing native ledger assets the moment a judge signs a court order. This assumption demonstrates a complete lack of understanding regarding global banking compliance and the tight constraints of capital adequacy ratios. Under international banking standards, any digital asset held on a balance sheet must pass through a multi-layered verification matrix known as the internal risk modeling process. This process evaluates the asset's liquidity velocity, its historical volatility parameters, its counterparty exposure metrics, and its performance under extreme systemic stress scenarios. Even though the legal classification has been settled in federal court, the compliance divisions of global clearinghouses must still run their own independent private simulations to determine how the asset impacts their net stable funding ratios. This evaluation takes months of continuous data collection. The flatline price action you see on the public tickers is not a reflection of zero institutional interest. It is the quiet, invisible period where banks are running these private risk simulations behind closed doors. While the retail community is paralyzed by frustration over the lack of immediate price movement, the Federal Reserve and international settlement bodies are finalizing the operational standards for programmable capital. A bank cannot deploy a cross-border liquidity bridge using a public ledger without ensuring that every single transaction complies with real-time anti-money laundering protocols and automated sanctions screening. This requires the development of a private, permissioned layer that sits directly on top of the public ledger architecture. This infrastructure layer allows institutions to maintain complete control over their internal transaction flows while still leveraging the absolute mathematical finality of the underlying public settlement engine. The development of these permissioned gatekeeping systems is what is currently consuming the engineering resources of global financial institutions. They are not interested in buying spot tokens to flip them for a short-term retail profit on a secondary exchange. They are building the compliance framework that will allow multi-billion-dollar corporate treasuries to route through the public ledger seamlessly without violating a single international banking directive. The retail day trader sees a dead asset, but the institutional architect sees a regulatory runway that is finally clear of legal obstructions. To understand the timing delay that is causing so much retail disappointment, we must analyze the strict implementation lifecycle of major core banking software upgrades. Global payment networks like SWIFT and the major clearinghouse international services do not update their underlying software systems on a whim. System-wide software rollouts are planned years in advance and are executed during highly specific maintenance windows to prevent any disruption to the global flow of commerce. The integrations required to connect traditional legacy fiat systems with a decentralized ledger infrastructure are massive undertakings that require thousands of hours of parallel testing. A regional bank must ensure that its internal ledger can communicate perfectly with the digital asset gateway, that the transaction fees are accounted for automatically, and that settlement finality occurs in under 3 seconds without a single point of failure. This testing phase cannot be rushed because a single software glitch could result in the freezing of millions of dollars in sovereign payment transactions. The market is currently sitting in the middle of this mandatory implementation gap. The technical blueprints have been approved, the legal green light has been given, but the physical integration into the global core banking matrix is running on a structured corporate timeline. The frustration felt by the retail community is a direct symptom of expecting an old consumer bull market model to apply to an institutional plumbing upgrade. In a standard retail driven crypto market, price discovery is driven entirely by speculative hype, social media trends, and leverage trading on unregulated derivatives platforms. This creates massive, volatile vertical spikes followed by catastrophic 90% crashes. The native ledger asset we are auditing is being deliberately insulated from this chaotic retail cycle because it is being positioned as a foundational piece of global sovereign infrastructure. A ledger that is engineered to settle international trade, manage central bank digital currency bridges, and absorb trillions of dollars in systemic friction cannot be left at the mercy of speculative retail day traders. The price is being systematically managed and stabilized within a tight macro range through advanced market making algorithms and institutional liquidity pools. This stabilization ensures that when commercial banking entities begin routing live operational volume through the network, the underlying settlement asset presents a predictable, highly liquid environment that does not disrupt bank balance sheet calculations. To accurately track where this system is heading, we must shift our focus away from traditional order book charts and dive deep into the mechanical pipeline of decentralized ledger vaults. Retail investors are accustomed to a market structure where price discovery is determined entirely by human buyers and sellers, placing bids and asks on a centralized interface. The modern institutional ledger operates on a completely different framework driven by automated liquidity protocols and protocol level settlement pools. When a major international banking institution routes a multi-billion dollar settlement transaction through the network, it does not interact with a standard trading desk. The transaction is automatically processed by smart contract layers that source deep liquidity directly from decentralized vaults built directly into the core ledger architecture. These automated market maker systems are engineered to provide mathematically optimized exchange rates between totally different fiat pairs in less than 3 seconds. The development and deployment of these institutional vaults represent a massive structural shift that requires total legal compliance before a single dollar of live operational capital can be safely deposited into the network. The current period of intense price consolidation is the direct result of these protocol-level liquidity vaults being systematically tested and capitalized under strict institutional supervision. Before a commercial bank can utilize an automated market maker pool as a primary source for cross-border settlement, the pool must possess a massive baseline of deep, low volatility liquidity. If the pool is too shallow, a large transactional settlement order will trigger severe price slippage, disrupting the precision balance sheet accounting required by international banking laws. To prevent this, institutional market makers and liquidity providers are executing private, large-scale capital provisioning behind the scenes. This capital is not being used to buy tokens on public exchanges to drive a speculative retail rally. It is being locked directly into the ledger's foundational vaults to establish a rock-solid, highly stable liquidity baseline. The retail community looks at the flat public ticker tape and assumes nothing is happening, completely blind to the fact that the foundational liquidity reservoirs of the new global financial plumbing are being quietly filled to capacity. A profound misunderstanding exists within the retail market regarding how these automated market maker vaults actually impact the long-term price velocity of the native asset. The common retail critique claims that because automated market makers constantly rebalance the assets within a pool to maintain a stable trading environment, the protocol will naturally suppress any upward price momentum. This argument completely misinterprets the mechanical reality of systemic ledger utility. The purpose of an institutional liquidity vault is not to permanently suppress price, but to eliminate arbitrary speculative volatility. When live cross border transaction volume begins to scale globally, the sheer velocity of the automated conversions occurring inside the vaults creates a massive, continuous demand loop for the underlying settlement asset. Every single cross currency transaction requires the protocol to instantly purchase and burn a fraction of the native token to cover network fees and execute settlement finality. The demand is driven entirely by automated non human software protocols operating at the core architecture layer, converting pure operational utility into a relentless upward demand force. We must also analyze the hidden connection between these automated ledger vaults and the broader institutional custody systems being deployed by major global banking cartels. For an enterprise or a regional bank to participate in a decentralized liquidity pool, the underlying digital assets must be held within an absolute enterprise grade custody environment that meets the highest security standards. This requires the integration of advanced multi party computation, cryptographic frameworks, and hardware security modules directly into the ledger's vault interface. Throughout this current phase of retail disappointment, the world's leading custody providers have been quietly building out the technical bridges that link traditional corporate banking treasuries to these automated ledger pools. They are establishing a highly secure, friction free gateway that will allow institutional capital to move from traditional legacy balances straight into the ledger's yield generating vaults at the click of a button. The retail day trader is looking for a quick social media hype spike, while global custodians are building a secure structural highway for multi-trillion-dollar capital migration. To truly understand the high stakes of the current market stagnation, we must look beyond commercial banking apps and analyze the structural decay of the traditional sovereign debt market. The entire global financial system is built on a foundation of government bonds, primarily United States Treasury bills, which function as the primary collateral layer for the international banking network. For decades, commercial banks used these debt instruments as pristine collateral to back their loans, clear their balances, and facilitate international trade. However, as global national debts balloon out of control and inflation permanently erodes the purchasing power of fiat currencies, the structural integrity of these debt instruments is beginning to collapse. Central banks across the globe are quietly realizing that relying on another nation's debt as a core reserve asset introduces immense systemic counterparty risk. This structural decay is creating a massive, unprecedented scramble for alternative, counterparty free assets that can provide instant settlement value without adding further debt to the global balance sheet. While the retail public is hyper-focused on daily candlesticks and social media hype cycles, the institutional financial plumbing is suffering from a severe crisis known as a collateral velocity collapse. In the old legacy system, a single treasury bill is often rehypothecated, meaning it is lent out, borrowed, and reused multiple times across different financial institutions to clear outstanding obligations. This complex chain of borrowing creates an incredibly fragile web of systemic dependency. If one major bank in the chain experiences a liquidity freeze or an unexpected credit default, the entire rehypothecation loop instantly breaks down, locking up billions of dollars in international trade settlement. The native asset of the decentralized ledger solves this systemic vulnerability by operating as an absolute counterparty-free settlement mechanism. It cannot be defaulted on, it requires no debt issuance to exist, and it settles with absolute finality in under 3 seconds. The institutional architecture is not being built to serve as a speculative retail playground, but to function as a pristine, high-velocity collateral layer designed to prevent a total freeze of the global financial system. The frustration over flat price action stems from a failure to observe the massive geographic realignment occurring within the global central banking matrix. For the past half-century, the international correspondent banking model has been dominated by Western clearinghouses and centralized messaging systems. However, developing nations and emerging economic superpowers are actively seeking to decouple their sovereign reserves from this centralized infrastructure to protect themselves from sudden geopolitical sanctions and asset freezes. They are systematically shifting their focus toward decentralized ledger technology that allows them to conduct sovereign cross-border trade directly with their partners without relying on a centralized Western intermediary. This sovereign migration requires a totally neutral digital commodity asset to bridge the gap between entirely different fiat currencies. The ledger asset we are auditing was engineered specifically to fulfill this sovereign neutral role. The pricing of this infrastructure cannot be dictated by retail speculation on public exchanges because it is being integrated into the foundational reserves of international trade syndicates. We must also perform a rigorous structural audit on the immediate operational cost savings that this ledger technology introduces to the global corporate enterprise layer. Under the legacy correspondent banking model, a standard multi-million dollar international transaction must pass through an average of 3 to 5 separate intermediary banks before reaching its final destination. Each intermediary bank extracts a processing fee, requires a separate compliance check, and delays the transaction by an average of 3 to 5 business days. Furthermore, corporations are forced to maintain pre-funded accounts known as nostro and vostro balances in foreign countries just to ensure that capital is available to cover local settlement obligations. This archaic system traps trillions of dollars in stagnant, unproductive corporate capital across the globe. By deploying the native ledger infrastructure, an enterprise can completely eliminate the need for pre-funded foreign accounts. They can instantly unlock their trapped capital and utilize the automated liquidity vaults to settle international invoices on demand for a fraction of a penny. The final phase of this structural audit requires us to confront the absolute reality of how automated price discovery will operate when the ledger enters its mature utility phase. Retail market participants are entirely trapped in a speculative mindset where they assume that asset appreciation can only be driven by a human being manually buying a token on a smartphone application. They are completely blind to the fact that the entire global financial architecture is transitioning toward a state of automated programmatic execution. In the mature ledger ecosystem, the vast majority of all transactional demand will be generated by autonomous software protocols, algorithmic enterprise routers, and central bank clearing engines. These machine entities do not possess human emotions. They do not read social media headlines, and they do not care about retail chart patterns. They execute transactions based strictly on mathematical optimization rules embedded in their core programming. When a cross-border payment router detects a multi-billion-dollar liquidity friction point, it automatically calculates the exact volume of the native ledger asset required to eliminate that friction and executes the clearing cycle instantly at the protocol level. This shift from human speculation to machine utility represents an absolute paradigm shift that completely invalidates traditional crypto trading models. In a market driven entirely by human speculation, price action is highly cyclical, dependent on retail sentiment waves, market manipulation, and short-term capital rotations. In a market driven by programmatic enterprise utility, price discovery is tied directly to the physical volume of value moving across the network. The native ledger asset functions as an absolute operational requirement for the movement of global wealth. Every single time a tokenized bond is settled, a central bank digital currency bridge is utilized, or a corporate invoice is cleared through the automated market maker vaults, a deterministic demand signal is forced through the ledger architecture. This structural utility creates a relentless, non-speculative upward pressure on the available circulating supply that cannot be shorted, manipulated, or suppressed by legacy market makers on secondary exchanges. The extended period of flat price action you are enduring is the mandatory structural buffer zone required to transfer ownership of the asset from emotional retail hands to automated institutional custody networks. A global financial infrastructure engineered to support the automated clearinghouses of the future cannot allow its primary liquidity layer to be concentrated within speculative retail portfolios. If a massive percentage of the circulating supply is held by retail day traders who panic and sell their assets at the first sign of a macro market drop, the entire stability of the cross-border settlement plumbing is placed at risk. The institutional market makers are systematically using this multi-month consolidation to run a psychological exhaustion campaign against the public. They are keeping the public ticker tape looking completely dead to force impatient retail holders to capitulate and sell their tokens back into the private institutional over-the-counter liquidity desks before the primary enterprise network activations go live. The definitive structural audit of the decentralized ledger infrastructure is now complete. The legal runway is perfectly clear. The enterprise custody systems are locked into place. The global messaging standards are fully unified, and the automated market maker reservoirs are completely prepared to absorb the incoming wave of tokenized sovereign wealth. The system is not broken, the architecture is working exactly as intended, and the structural pieces are fully assembled. The only remaining question is whether you possess the institutional macro conviction required to maintain your position through the final phase of retail exhaustion, or whether you will let short term timing disappointment blind you to the absolute reality of global capital migration. The plumbing is built, the compliance clock is running out, and the final programmatic switch is preparing to flip. Choose your side of the ledger and lock your focus on the macro lens.